At Insightful Value, we love spotlighting companies that fly under the radar, and Exponent is one of them. You might not hear about it every day, but when a highly profitable niche company like this sees its stock drop, we pay attention. Today, we're breaking down whether Exponent is just temporarily out of favor or facing something bigger. This review is for informational and educational purposes only, not financial advice. If this kind of breakdown helps you, make sure to like the video and subscribe to the channel. So, what does Exponent actually do? Exponent is a multidisciplinary engineering and scientific consulting firm. They're called in to solve complex problems. Think product failures, accidents, structural issues, or even environmental disasters. Their clients range from Fortune 500 companies to governments and law firms. In a world where everything is getting more technical and litigation risks keep rising, Exponent has carved out a high-margin, high-trust niche. The stock, however, has been under pressure lately. Despite being consistently profitable, shares have drifted down from their highs, making some investors wonder whether the valuation has finally caught up to reality. Exponent is known for being expensive in terms of valuation multiples, but that premium was always justified by its consistency, strong returns on capital, and zero debt. Now that the price has pulled back, value-oriented investors are starting to take a closer look. Financially, Exponent remains solid. In the most recent quarterly earnings, revenue came in at roughly $140 million, with net income margins above 18%. The company has very little capital expenditure and no need for large-scale investments, meaning a lot of that cash goes straight to shareholders. The balance sheet is pristine. No debt, significant cash reserves, and a track record of returning capital through dividends and share buybacks. Speaking of dividends, Exponent has been quietly increasing its dividend for over a decade. The yield may not be massive, hovering just under 1%, but the consistency and growth rate make it a reliable signal of financial health. In addition, the company tends to buy back shares opportunistically when it believes the stock is undervalued. But of course, there are risks. One major challenge is Exponent's reliance on a specialized workforce. The company's expertise is its main product, and if talent gets more expensive or harder to retain, margins could be squeezed. Another risk is demand sensitivity to legal and regulatory changes. If litigation slows or companies reduce consulting budgets, Exponent may feel the impact. Also, some investors worry that with such high historical valuations, even a small miss in expectations can lead to outsized stock reactions. So, why consider the company now? With the stock down, valuations are more reasonable than they've been in years. The company remains highly profitable, has no debt, pays a dividend, and operates in a niche that's not easily disrupted. On the flip side, growth is moderate and predictable, so you're not getting a hyper-growth story. This is more about long-term consistency than explosive upside. At Insightful Value, we're all about cutting through the noise and showing you companies that deserve a deeper look. Whether you're a seasoned investor or just starting out, we help simplify complex companies like Exponent so you can make smarter decisions. Want more insights like this? Check out insightfulvalue.com for detailed breakdowns and fresh ideas. If this video helped you think differently, give it a thumbs up, subscribe to the channel, and share it with someone who's also looking for value in overlooked places. And remember, you can always get more at insightfulvalue.com.